Hi, everyone. This is Aristotle with RealWealth, and today we are talking about what's happening with interest rates and what is happening with interest rates. Everyone's always asking me on the phone when we do our strategy sessions, what's going on with lending, et cetera, et cetera. So we're going to dive into it, and we have a lot to cover today. So with me today, we have Aaron and Graham with Highlands Residential Mortgage. How you doing, guys?
Great, thanks.
Awesome. Thanks for having us on.
Yeah, absolutely. We're really excited to have you guys on here. It's been a while. So if you can go ahead and advance to the next slide, we're going to get a couple things out of the way first before we dive into today's presentation on interest rates and mortgages. So we have our next webinar next Thursday is going to be our Charlotte, North Carolina team. So if you're interested in looking at that market for a property, join us for that at 12 p.m. Pacific time. And then the week after that, we have no webinar because it's kind of like a holiday week for 4th of July and everything. And then we have our live event. So we're celebrating our 20 years. Can you believe it? RealWealth has been around for 20 years. It's amazing. So Friday and Saturday, October 6th and 7th in Los Angeles, we're going to be having an event. So you can register there at our website if you're interested. It'd be great to see you. We haven't had a live event like this in the California market for quite a while. So excited. So let's go and go to the next slide here. I'll read the disclaimer. It basically says that strategies mentioned in the presentation may not be appropriate for everyone, and other options not mentioned may be more suitable for your specific circumstances. And we always recommend you consult your personal accountant, CPA, tax advisor, and attorney to discuss your situation. And past performance is no guarantee of future results. Real estate purchases are subject to investment risks, including the possible loss of amounts invested. And while every effort is made to maintain accurate and current information, the possibility of errors and or updates always exists. All right, so here's what we're going to go over today. We're going to be talking about what's happening with interest rates today, to buy points or not to buy points. That is the question. How to calculate mortgage points. That's actually a really good topic. Credit scores and interest rates, top mistakes borrowers make, cash out refinance versus a HELOC, Highlands' new float down program, which you're going to want to hear about that, and then we'll do a couple of Q&A at the end. So while I have the Q&A topic up there, on the right-hand side of your GoToWebinar panel, you'll see a question or chat box. You can go ahead and type your question as we're going along, and we'll try to answer as many as we can at the end. So let's go ahead and get started here. I'm going to talk about Graham real quickly. So Graham is, I don't know I think Graham, how long have you been with us for now? Has it been a decade?
I think so, yeah.
Yeah, so a long time Graham's been with us, and he's fantastic. And you'll see there that he's been a mortgage officer, loan officer for 25 years. And just brief scenario, I'm not going to go through everything on here, but Graham's an investor himself. He's purchased properties through numerous of our property teams here, and he comes to most of our events. And he speaks, and you've heard him on our podcast, etc. You can see there he currently owns 45 investment properties. So he's doing everything that you guys are doing or want to do. So that's important. I think having a lender that's buying properties and using financing and leverage like you guys are going to use, that's always important. And so Graham, go ahead and take it away. I know you're going to go ahead and introduce Aaron, and let's hear about who he is.
Well, back 8 years ago, I needed an assistant. So Aaron was, his mother was my dentist. So he came in, I interviewed him. He's green as he was, and right out of college, right at A&M. I should have not hired him right then and there at A&M, but brought him in. He's been fantastic ever since. It's been a big sponge. I eventually promoted him to my partner. So yeah, he's truly my partner now. He just started jumping into the investment thing. He keeps on seeing all these tax returns coming across the desk. So he's sorry, I'm going to jump into it as well. So he just closed on his, 6 months ago, I guess?
Yep, beginning of the year.
Yeah, it's the Airbnb, believe it or not. But he's been an extremely helpful tool. He's really good at what he does, and he's my left hand. I mean, he's my right and left hand. So yeah, thank you, Aaron.
Appreciate that intro. So let's jump right in, right? Why we're all here today, and that's what's going on with the interest rates today. And we're fresh off of some big headlines these past 2 weeks. Of course, the biggest one that a lot of us have seen stemmed from the latest Fed meeting on the 13th and 14th last month, and that, of course, was the pause on these interest rate hikes. This is the first time, actually, after 10 straight hikes that we've seen over the past year and a half, essentially, that they've chose to pause. And I want to back up real quickly, and what we're talking about here, guys, is the Fed funds rate. Now, this is not necessarily mortgage rates, but it impacts it in a huge way, as a lot of us, I'm sure, are aware, along with your credit card rates, your auto loans rates. It's the overnight borrowing for these big banks, and it impacts everything, especially mortgage rates. So as I just said, we saw the first pause after 10 hikes, and that is really, really good news. But we're seeing it's being a little overplayed, because what we're here to kind of share is we're not out of the weeds just yet when it comes to these mortgage rates. And let me jump to the next slide here. On the mortgage side, and again, what me and Graham are going to try to do here today for all the viewers is there's so much that goes into the economy, but we're just going to zero in on the mortgage side and the mortgage rates, because that's what we deal with every day. And one of the closest things that mortgage rates follow is, in fact, inflation, or our CPI. And if we take a look historically, we'll get to that in a second, at our overall inflation, the headline CPI numbers, our mortgage rates will follow that. So for example, going back to how we, aren't out of the weeds just yet, last June, so about a year ago today, give or take, we were right at 9% for the headline CPI, 8.9, they recently revised it. Since then, in a year's time, we've come down to where we're at today, which is 4%, which is awesome, but it's not enough for the Fed just yet. So what they're ultimately wanting, what they're targeting, is a 2% CPI number. If I jump to the next slide here, I'm just going to go ahead and fast forward here. I want to take a look at our 12-month overall CPI. So this has.
Let me interject.
Yeah,
The Fed fund dictates the market, okay? And yeah, it's almost like the Fed saying, okay, we want to stop this train right now. Well, here comes a train that doesn't stop. Well, let's do a price hike. And all right, now stop now. So 10 times, and when the Fed paused this last month, I still think they left the back door open. Okay, I just had to throw that in there, Aaron. But continue.
Yeah, no, I'm glad you did. And actually, so one of the key reports that we keep an eye on our side is known as the Fed futures, and what that does is it's a firm prediction and what we're gonna expect, and as far as future Fed hikes are concerned. And as of yesterday, in fact, I was actually at a 75% chance that we're gonna see a quarter basis point hike come July. So although we had a pause in June, it's more of a pause and wait for the Fed. Let's see things play out. Ultimately waiting for some new CPI reports, some new other reports to come out, but they're not satisfied with that 4% area. If we take a look at just our overall headline CPI here, and it's a lot to take in right at first, but this factors in everything from shelter to food. It's the full headline CPI. Here's a 20-year snapshot. And of course the 08 recession, but you can see since then, we've tightly kind of hugged this 2% target barrier. Now, if we take a look at the last 5 years, let's kind of zoom in here. We can see we were nicely hugging that 2%. COVID came around, really dropped down a little bit, and then things after these lower rates hit, inflation really spiked up beginning about 2021, all the way up to that 8.9% threshold. But what I want to zero in here is look at this nice decline that we've been on for just about a year now. We're making good progress, and what's happening is, if we take a look at our next graph, just a quick graph here of the 30-year mortgage rates, we can see that, again, we just saw our CPI started to take off in 2021. Of course, all things government, it took a little bit of time to react, but once we did see some reaction, our mortgage rates started to jump up. Of course, we got out of that 2-3% magical land we were in there for a couple of years during COVID, but of course we shot up at one of the fastest paces we've seen in 40 years, up to kind of that 6.5 ping pong threshold that we've been at. Now this next graph, guys, this is what really gives us a lot of hope, and I really love to share this to our viewers, because if we look at the blue line here, here's our CPI. As we just talked about, mortgage rates follow CPI. As the CPI jumped up, mortgage rates lagged. They eventually followed that and jumped up. And now we're seeing the CPI start to harshly fall, which is great news. The whole point in the Fed hiking this Fed funds rate is to get this inflation under control. It's working, but it just takes time. the key here is that these mortgage rates, it's still going to take a little time. Right now, the projections are probably first quarter of 2024 when we start to see this really start to follow the CPI. But what we're showing here is that everything is trending in the right direction. So while we're still kind of in this ping pong territory for the next few months with two basically rate hikes still expected throughout this year, we're gonna continue to see us kind of ping pong back here until we get reassurance, we get that CPI down to that 2% threshold that the Fed is wanting, and then we'll see some relief in that regard.
And just to interject on the anticipation of the Fed's trying to get to 2%, I mean, I take Kathy's presentation from about a week and a half ago when she was showing the stair steps of the hikes versus the stair step of the hikes back in the 90s. They were easy steps back then. These were not easy. These were straight up steps. But you keep making those large steps, this is going to eventually break, which means we're going to hit that recession wall, okay? And when that happens, when we all know that the recession, it brings the market back down again. But it will break. Something will break. Go ahead.
Yeah, and that's a great tangent, Graham, because that kind of leads us, and here's just kind of reiterating what we just recapped, but this was straight out of, we had another meeting yesterday for any viewers that aren't aware, and the Fed just kind of reaffirmed that they're expecting probably 2 more rate increases, rate hikes, before the end of this year. So they're sticking to that message. They're adamant about getting that inflation down so we can hopefully have that soft landing on the recession. And that kind of brings us into our next point about discount points. And everyone wants to know, why am I paying points on my loan these days? I've bought, properties for 6 years before this, never had to pay a discount point on them. What's going on? So Graham, I'll let you dive in there and kind of explain the behind the scenes of what we're dealing with.
I don't have control. All right, thanks. First of all, we've got several slides on this to talk about what a par rate. A par rate is 0-point pricing. I've been at this for 25 years. I've always had par pricing available, regardless of where the market was. We always had it available. The reason why we don't have it available now is that back during COVID, the guys that were buying those mortgage-backed securities back 17, 18, and 19, they experienced a thing called early payoff. Okay, when they buy these mortgage-backed securities, they anticipate to keep them on their books for 3 to 5 years, and all of a sudden they got early payoff. So whatever margin they thought they were going to make, it was taken right back from them. So if you can imagine at the peak of the market, say December 4th quarter of 21, the cost that the secondary market was willing to pay, let's just say it was 6 points. Today, we're probably priced at about 3. Well, if you're a lender and you have to cover your overhead and you need to at least sell it for 4, well, then who's going to cover that 1? Unfortunately, the buyer is. So what I'm trying to say is they're not juicing or giving as much margin as they normally would, which is, leading into everybody having to pay points. It's their insurance policy because they know this stuff will be paid off in the next 12 to 15 months. Okay, go ahead, the next one there. And once again, same illustration. You lend $500,000 and you sell it for $500,000. Nobody makes any money, so that's not the main objective. Next screen, please. Like I said, this is just kind of basically reiterating what I said earlier, because if you talk to whatever lender you can talk to, we think we're off 400 basis points of where we were about a year and a half ago. Some may say 2.5 or 3. I don't know, but it's still enough to filter down and obviously get that consumer to pay that particular point. Go ahead. Same thing here. We're trying to expedite and speed up things pretty quickly, but it all has to do with mortgage yields. The next one, please. Okay. So I think I talked about that. So chances are, and I'm just going to touch on this right now because of this, is that we are going to experience running into the recession wall. We are going to see that the rates are going to come back down. Predictions say probably first quarter, second quarter next year when that happens. Feds know this, we know this. And when I say we, Highlands Mortgage, we have a thing called a refinance guarantee, where if you do secure property this year and you secure a higher rate with us, come back in the next 3 years and we'll, when the rates come down to a palatable level, and we'll refinance you. We won't charge any closing costs. Okay. Next one, please. Now, this is something I want to explain to you where we are today. At the top part, all right, it's $250,000 purchase and 25% down. And one says the normal market, one says today. The normal market was 2 years ago. Okay. Remember I said I could always get a par pricing, always get 0 point pricing. Well, that's the way it was. But what was interesting back then, and it was for many, many years, is that you can almost predict the coupon differences. And the coupons are, okay, it's 7%. And if you buy it now, it goes to 6.75. It usually would equate to 1/4%. And if you did that back during those years and you wanted to buy it down, you can see 5.4 year return. I don't think that's a good return. I'd rather see closer to 3 years or 3 to 5 in that case. But now here's the good news. Even though rates have gone up, the margins are a little bit broader, if you will. Okay. Remember I talked about on the top part, every 1 point equals 1/4 point in rate, and it keeps going down. Well, in this market, buying points actually is to your advantage. Okay. There's a lot of sellers right now that are willing to pay some concessions in the marketplace today, but for both primary as well as secondary. But you can't exceed 2 points in seller concessions, just to let you know. But let's say you had 2 points. Okay. All right, let's say today, because of what the margin squeeze, I have to pay a point at 7%. If I wanted to pay 2 points, I dropped it down 0.75%. That's 1.68 year return. That's not bad. And guess what? If the seller pays those points, you still got a good return on your investment. Okay, does that make sense? Go to the next screen.
Yeah, and just to elaborate there a little bit, what he's talking about, the return, guys, that break even that's when mathematically it would make sense to buy those additional points. So if you're sitting at the 7%, trying to decide, man, should I buy down that 6.25 with 2 points? Well, the question is, am I going to have this loan in place for at least 1.68 years? As soon as you pass that territory, then yeah, it makes sense, dollars and cents wise, to buy that down every single time. So we're seeing as far as additional buy downs, that you're getting a lot more bang for your buck these days, just as a byproduct of kind of the crazy volatile market we're in at, versus in years past, it was always just really at that 5-year return, and you couldn't really get magical kind of extra points, where we're seeing those kind of left and right, every single day.
When we see these craziness going on, sometimes those coupons could be a 0.5 point difference. It could be, I've seen them up to 7/8 point difference. It's huge. The rate drops 7/8 points only for buying 1 point. Once again, we don't want to touch on this. It's basically the same thing. In the normal market, you don't want to get a 5.99 year return, or should I say 5.996 months. Anyway, 6 years, excuse me. Or 5 years. And if, say, the longer went up, okay, so this does not include principal and interest, so keep that in mind. That doesn't happen anyway. So go to the next screen. And here basically shows you a better rate of return if you get a larger spread on the coupons. Okay, next screen, please.
Yeah, and I want to talk about this one real briefly, Graham. One thing that I know a lot of our borrowers, are always trying to figure out, which we definitely are hammering home, but I want to continue to hammer that home, is just how do I figure out if it's worth buying those points or not? And while there's kind of a lot of text here, it's simple math at the end of the day. And while, as loan officers, me and Graham are always there, 24/7 to help walk you guys through it, whenever you want to just do some scratch math on your own, it's very, very simple to figure out. So in this case, we take a 7% rate, say that gives us a $1,330 a month payment. We just find, the cost, the 1 point cost, in this case, would be $2,000. How much money a month would that save us? It would save us $66.46 a month. And we just divide those over each other. It gives us 2.5 years. So it's real quick math to do it. And regardless of, you're working with us or another lender or private lender, it's important to walk through all your options. Don't just take the first rate offered to you. See all the options on the table, because depending on who you are as a borrower, your goals, if you'd rather keep that point, that cash for your next property on your portfolio, all that comes into the equation when you're looking at buying points. So, important to understand what goes into that math and how to do it yourself, as you work to build your portfolio.
Go to the next one. There you go.
So this is a fun one that has been getting a lot of media attention, a lot of headlines the past month, and that was these on our side we call them LLPA adjustments, but it's this whole headline about those with poor credit are now going to start getting better mortgage rates than those with the 800 credit, and we're here to kind of explain that and let you know there is some truth to it, but it's not that clear cut, and still at the end of the day, those with better credit will always, at least for now in the environment we're in, continue to get much better mortgage rates than those with bottom tier credit. So
let me add some to that. How rates are determined. There's 4 things that rates are determined: credit score, percent of down payment, property type, whether it be a single family or 2 to 4, and then of course the loan amount. And I want to talk a little bit about loan amounts right now, because if you think about what we just discussed, that Wall Street recognizes that we're going to probably have early payoffs in all these loans. Okay, so we also recognize that. Well, if you take as an example, take 5% of $100, that's $5. 5% of $1,000, that's $50. So that's a $45 difference. When lenders go to do when they analyze if it makes sense for you to refinance, in our world, I usually say if it's $100 to $150 difference, but to cover up the closing costs, it usually works it. And remember that 3 to 5 year scenario? That's what I usually focus on. So, but the problem that we're seeing right now is the higher loan amounts are getting stung even worse, which makes having to pay more points. It's crazy, and they go up like $25,000 increments. And the higher, in other words, I could probably get, I don't know, a quarter to 3/8 better in rate with a $100,000 loan than I can with a $500,000 loan, because those are loan level adjustments. You got to keep that in mind. That's why they put them there. Go ahead.
Yeah, those have gotten a lot steeper. We've seen that to where, you know, we are seeing a higher penalty on those. You know, borrowers just having to pay more points at the end of the day for these larger loan amounts when comparing it to, you know, lower loan amount. But the other thing that's been getting a lot of headlines, of course, is the credit score implications and how that affects the rate. And ultimately, it came from a good-natured place, but it's kind of weird in a lot of people's opinions on how they came up with this new grid, this new LLPA adjustment. So essentially their goal at the end of the day was just to improve costs for those with lower credit scores. And as a result, it did increase costs slightly for those with higher credit scores. But again, it's those with better credit are still going to get a better rate all day long. And we've got the exact grid. If we take a look here,
the FHFA did this for low to moderate income buyers. Okay, that's exactly why they did it. Okay, so we're going to show you what they're giving to these low to moderate income buyers. Typically, well, let's just go right to it. I don't have the arrow, so there's 2 columns there in the middle. There's a 70.01 to 75, and then a 75.01 to 80. We'll just call them column 75 and 80. Look at that column 80 on that credit score of 740 to 759. That's not a benefit, that's an adder. Remember we told you before, there's so much margin in the box. When you get that 30-year fixed rate, we're going to take some margin away because it's not owner occupied. We're going to take some away because they're not putting enough down, or whatever the case may be. This just happens to be one of those adjustments. But if you look down the page at the 660 credit score to 678, they got almost a full point adjustment. That's a credit. Even though it says negative, that's a credit. So they're giving that back to the borrower in pricing. And that's what they're saying, well, why do I have to pay for this? Well, in my opinion, it's the administration's way of playing Robin Hood. You know, if you think about it, back in 2021, you know, they tried to limit the investment and the second home delivery in Fannie Mae. Everybody says, well, if you're a lender, you can't deliver more than, you know, 10%. And that they did that mid-year. We were like 20 or 25%. So that went away. And now this is coming up. There's a lot of controversy on this, and eventually that'll go away. We had another, right when they launched this, they launched a DTI at 40%. Well, that eventually went away. So You know, I scratch my head sometimes when I think about why they're doing this, and nobody can ever figure this out. And they constantly are criticizing this one. But if you, everybody keeps saying, well, what about the LLP adjustments? Well, there they are. Okay, it's real. Okay, go to the next one.
Yeah, and real quick, guys, so this top graph here shows the changes that were made. And if you look at the bottom table, that is where we're at today after the changes. So let's look at the 75 to 80% column, for example, and you can see at the very top, we've got 3/8% going all the way down to 2.75%. What that means, to kind of put that in layman's term, say, you know, the rate's 7% at one point today, that borrower is paying, you know, 7 and 1 3/8, and then the one at the bottom is going to be paying, what is that, 4 1/8. So it's still, this kind of shows, this is some of the adjustments that go into rate, but you can see any way you cut it, when you factor in everything, the worse your credit gets, for the most part, these adjustments still continue to get worse. So that shows, you know, it's not red at the top, green at the bottom. We're still getting, you know, better rates for those with better credit. But they did, as Graham said, kind of, you know, rob Peter to pay Paul in a way.
Let me point out one other thing here. Let's take the bottom chart and take the 760 to 799 credit score in the 60 to 70% column. And people ask me all the time, if I put more down, can I get a better rate? Yes. The way it starts is 20%. And you get killed on 20% with the points right now. Typically, it's about a point difference. So you go you get a discount going from 20 to 25, and you get another small one going to 30. And there are no discounts beyond that, just to let you know. Go ahead.
So now we're going to jump into a fun one. I'm going to let Graham kind of lead with this, but we love to include this. It's good, even if you think you're a veteran borrower. Some of this stuff is easy to overlook, and by now we've kind of seen it all, but we certainly want to avoid these. So go ahead, Graham.
1031 exchanges. It's amazing how much a loan officer can screw up a 1031 exchange if they don't know what they're doing. And I give a lot of tribute to Aaron. He's a master at this stuff. But the bottom line is, before you're selling the property, think about how it's titled. Please get in touch with a aggregator or a loan, an exchanger, excuse me, and make sure that you understand these requirements. Because as an example, if you have your property currently in an LLC and it's a sole member LLC, well, then the exchange will actually allow you to go from a sole member LLC, 100% owner, to just a regular borrower with not having an LLC. And the reason why I'm saying this is because Fannie Mae and Freddie Mac, that particular, all those mortgage-backed securities are sold as personal loans on the secondary market. Personal loans for primary residence, personal loan for investment properties, and second homes. So as a personal loan, they do not let you title it into an LLC. That's usually done something post-close, which I'm not going to elaborate about, but it does happen. On an exchange, if you know you're going to sell your property and you know you're going to do an exchange, you know, you talk to the exchanger, but the second person you want to talk to is Aristotle and his team. And if you tell them you're doing an exchange, and help me out here, Aristotle, does that kind of put them up at the top?
It does, absolutely. And Graham, just for people who are new to it, 1031 is a tax deferred strategy. So for people who don't know what that is, I'm gonna throw that out there. But yeah, definitely. If you're thinking about doing 1031, our teams will definitely put you at priority to help you identify properties. Absolutely.
That's the most difficult thing on the exchange, identifying. Okay, can you screw it up and not, you know, take it out of your LLC? Let's say you got a multi-member LLC, your husband and wife. And now they sold it in their LLC. Now they come to me and I have to put it in their individual names. 1031, they won't allow that. Only on sole member. Okay. Quitting your job in the middle of a loan process. How many times, Aaron, if we had $1 for every time somebody did that, we'd have a lot of money. It's crazy how people assume. Let me just give you a real quick summary. Our job is to get you a loan. We're going to do everything we can to do that. If you're 100% forthright with us about everything, the reason being is because it's our job to give you a loan and keep you out of harm's way. And I've had some people that think they can, you know, pull wool over your eyes. You cannot do it in this industry. There's so many things that we monitor over and beyond credit report. We have a mirrors report, which talks about any real estate owned. We have fraud guards. We have a LexisNexis. We have several programs that we utilize. If you're trying to do something behind I will catch you, okay? That's just the way it is. Now, has some slipped through the cracks? Yeah, but that's okay. That's something they had to deal with. Sorry. Talked about, oh, okay, so signing multiple contracts without considering, yes, please let us know. We can get you approved. Now, the good thing about when we approve you, we just arbitrarily just put in $150,000 and we put a 20% down just to go the highest way of underwriting this. And if we can approve you for one, we can approve you for 10. The reason being is because if you're out buying multiple investment properties, you get multiple investment income coming in. That's going to offset the liability. And one would think, if I do that, my debt to income is going up. No, if you buy right through RealWealth, your actually debt to income is going down because you're adding more cash flow. Okay. Get pre-approval before the contract. Yes. Buying multiple properties. I just talked about that. Not disclosing free and clear properties. I got a piece of lot. I got a lot in Florida. I got a farm or whatever. Please tell me about them all. I just want to account for them, because if you don't tell me, then we sell the loan. All of a sudden we get the loan back because Fannie Mae went through it and did some more auditing, and they found this, and then they either come back to us and say you buy the loan back, or you redo the loan and send it back to us. Most of the time we can redo the loan, incorporate what we missed. In this case, it was an empty lot or whatever, and then we resell it to them. Sometimes we can't. If somebody, I had one 2 months ago that was buying an investment property for me. It was like I don't know, 175,000, but they're buying $1 million second home in California. He didn't tell us that. We tried to bring it back and fix it. We couldn't fix it within the Fannie Mae box. So as a lender, we had no choice to say we have to call the note due. So just keep that in mind. Let's go to the next one.
Yeah, and real quick, a lot of these things, you know, if you're a borrower and you're thinking about buying or getting pre-approved, and you're thinking, oh, well, I might be, you know, changing jobs coming up, or I've got, you know, this medical bill coming up, I'm gonna be taking out a new debt for that, or going out of the country. There's ways for us to still get through all of these barriers. As Graham was alluding to, communication is just the key. So when we know about it and we can plan for it, it's definitely, you know, as long as it still fits within the Fannie Mae guidelines, no problem. Going out of the country, let's get a POA. Getting a new job, let's just document it. New debt, let's factor it into your DTI. So a lot of this, these aren't, you know, hard stops in the process by any stretch. But the communication is everything, because we get out in front of these, we know about it, and then it's smooth sailing, you know, up to your 10 Fannie slots and beyond. So yeah, perfect. When we get outside that, we're going to the non-QM world. So go ahead, Graham.
What the government did after the 08 bust is they created this document called the Dodd-Frank Act, and that's what governs our industry. I don't know how many pages, it's too many pages actually, but there was a lot of things that good things that came out of it, not so good things that came out of it, but it is what it is. That's what governs our industry, besides the FHFA and the CFPB. But the non-QM loan was created because it's outside of those guidelines from Dodd-Frank. Dodd-Frank got rid of interest only. They got rid of the 40-year term. They got rid of prepayment penalties, got rid of a lot of things. So, well, that's good. But for investors, we're saying, well, wait a minute, I like my interest only. You know, I don't mind a prepay, whatever. Well, the main reason why the non-QM loans, a qualified mortgage is Fannie Mae, Freddie Mac. Non-qualified mortgage is everything other than, okay? And if anybody's outside the 10 box, which means they've already acquired 10 loans on their credit that are their residential loans, 1 to 4 property, then you have to go into the non-QM world, okay? The math is a little differently. When we do a loan through Fannie and Freddie, we take a look at your credit, how much you make and how much you have, okay? In this case, we take out how much you make, because we're going to let the property make it for you. That's why it's called the DSCR. And there's some other advantages as well. These allow you to put it in LLCs or partnership. As you can see at the bottom there, bottom right-hand corner, we just take the gross monthly income and divide the debt into it, and that's how we come up with a thing called a debt service ratio percentage. They usually like to see it at least above 1. They would prefer to see it above 125. We do from time to time go below 100, down no more than probably 75, and that's for maybe a property that has some weak income. You know, it is what it is. Potentially quicker closing times, I'm gonna say, yeah, maybe. we average from 21 to 30 days right now. You're not limited on the number of properties. You can go all the way up to $1 million. You can also do the cash outs, interest only, suited for new as well as seasoned borrowers. We can do it on both the short term, the Airbnbs and VBROs, as well as long terms. And they have non-warrantable condos. I got to tell you, when we run into those non-warrantable condos, they are a bit challenging. And then, of course, we have a 40-year term on these. So there are a lot of advantages on the non-QM if you decide to go that route. Once again, always use your golden tickets up first because these rates are higher. Okay.
Hey, Graham and Aaron, what just out of curiosity, what is the average interest rate on a DSCR loan right now?
It's going to be in the upper sevens and the upper sevens to middle fives. Remember we showed that loan to value adjustment, and I said, okay, you get a discount for 25, you get a discount for 30. Well, they keep going, which is kind of good. Okay, so if you're doing it for a 50% LTV, you're going to get a better rate.
Exactly. Yeah. While Fannie's closer, if we're talking investment properties, 6.25% to 7% range. Add about 1% on top of that for the DSCR. So yeah, closer to upper sevens, low eights, depending on the property, of course, has everything to do with that rate.
All right, next slide, please. Leverage is your friend. I've been saying that for years. Use it. I've talked to so many investors over the years, and they say, why don't you just pay off your loan? Why? I know how much my cash flow is today, and I know how much it's going to be tomorrow. Why? Well, what about your heirs? What about them? If I die, I'm gonna leave them a piece of property. I don't care about paying it off. I'll let them worry about it. So it is useful. And right now is a great opportunity to think about what's going on in the world. We are now in a seller's market. There's more product out there, okay? But let's say you may be short a coin. So what do I do? Do I do a cash out on my house? Do I do a HELOC on my house? Or do I do a HELOC on another property or a cash out on another property, which is investment property? Here's what I think about both these products. HELOCs are great. I encourage everybody to go get you a HELOC and put it on your primary residence because it's a lot easier to get it on your primary residence. To do a HELOC on an investment property is quite challenging. Aristotle, you're welcome to join in. How many do you know out there? 2 or 3 tops?
I don't know any. I mean, even I sometimes recommend people to talk to credit unions, but a lot of those don't do them anymore. So I don't know anybody who's doing them.
Yeah, it's very, very challenging to get those. I would love to have a HELOC on every one of my properties, but it's just not there. I recently did 3 cash outs this year because I had set my sights on these new projects that I'm doing. So I mean, in January the rates were up, but I had to go through DSR, but I did the cash out. It made sense on a 1 loan basis. Now let's say that you could get a HELOC on an investment property if you find them. Well, it's usually prime plus something. Prime's at 7.5 right now, and the plus something on investment property is usually another 0.2 to 2 points. Now you're at 9.5. Whereas if we did a cash out today on a Fannie Mae, we're close to 7. So it doesn't make sense to utilize a higher point margin on the HELOC than it would be to get just a straight 30-year fixed rate. Okay, next screen. Same thing. Interest rates are higher. And use it for cash out. That's what I say. I used it for myself. I went out and bought three new properties with the properties that I cashed out on. It was great because last 5 or 6 years, I mean, the appreciation, everybody should take advantage of that appreciation. There's equity in these houses that you've owned for 5 or 6 years. Next.
Question for you, both you guys, on HELOCs and cash out. So a question I get a lot from investors are, should I get a HELOC on my home or should I just take cash out? Do a refi? You guys can help strategize with our members, right? To look at the scenario and say, okay, this is what your payment's going to be. I mean, obviously, it's going to be ultimately up to the investor to make that decision. But will you guys help strategize a little bit with that too and look at that scenario for them?
Absolutely, and we'll go through exactly what I just described. Because let's say an investor has an investment property and he can't find the HELOC. Okay. All right. Well, I can do you on a 1 loan basis. Well, I've got this 4% rate on there. Well, that's what's the mental thing you have to say. What's important to have that money now, or do I have to wait till the rates come back down to do this? So you have to ask yourself that. Yeah. On the 3 properties that I had, some were in the 5s and the 6s, and I ended up in the 7s. But I needed the money right there and there, so it made sense for me to do that.
Yeah, a couple other tidbits just to kind of, as our listeners are taking down some notes and food for thought. When it comes to a Fannie Mae cash out on an investment property, we're talking 75% of the appraised value. So that has a lot to do with it. Is the property free and clear? What's the current loan amount? We certainly don't want to, have a borrower be out an appraisal fee and then, where it appraises not even enough to get any money back in the pocket. That is for a single family. If you're talking 2 to 4, that does jump down to 70%. But yeah, absolutely, that's something we walk, through all our borrowers with when they're looking at a potential refi. Where were you at if you had a mortgage on it? Where does that compare to our rate now? And what kind of cash are you actually going to get back into your pocket? For your plan for that. So another, Graham kind of mentioned our refinance within 3 years where you come back, we'll take care of our lender fees, no question. We also have another great program that goes on all of our loans right now outside of a jumbo loan basically, and that is our rate float down option. This applies to purchases, refinances, both cash out and rate and term, and it's a completely free program for our borrowers, does apply to investment properties, and it's as simple as once we lock in, say we're at 7% today, if the market improves by at least 0.25% prior to closing, within the 14 days prior to closing, so say we lock in at 7% today, we're a week out from closing, the market has recovered a little bit, we're at 6.75%, we're going to adjust that fixed rate down to that new rate, no cost to you. That's going to be your fixed rate, and we'll send you on your way. So that's a really unique program that we just rolled out this month, I think just 3.5 weeks ago as of today. It's really awesome. Again, it's completely free for all of our borrowers. All they have to do is sign up for it whenever we lock the loan, and there's no cost associated with it whenever we exercise it at all. So it's a really great program. We noticed and management noticed that a lot of borrowers, with all the volatility that we've seen, they're trying to time the market and check in, hey, do I lock today? Do I lock tomorrow? What do you think is going to happen next week? Well, this helps kind of put all of that to rest, to where, hey, you're locked today. If it ends up improving, we got your back. We'll lower it down, and there's not going to be an extra half point snuck in on you. It's all free.
Well, I always tell my borrowers, if you locked in on a rate today, then the rates went down, would you be more upset if you didn't lock them when they went up? Well, in this case, we got you covered on both ends. All right.
Exactly.
And like I said, I've been talking with investors for 25 years, and you guys all ask the same questions over and over. So I decided to put it in writing, and it's been a helpful tool. And I didn't really write it for you, Mr. Investor. I wrote it for me because you got so many questions, and I'm going to answer them before you ask, and this is in that guide. So I wrote that specifically to help borrowers get through the transaction. And there's a go back there, Aaron.
Sure.
Right at the bottom is where you can download that book at theinvestorsloanguide.com.
Yeah, it saves as a PDF, very easy to keep on file.
Yeah, and just so you know, you guys, I just texted everyone in the webinar here that link. So if you guys go to the chat box, the link was sent out to everybody right now. So you can click on the link and it takes you right to that ebook.
Awesome.
Well, what's next, Aristotle? This is how you get. Aaron and I work as a team, and we work as partners, but we have individual cell phones and work phones. So those are the information there. If you just want to talk to both of us at the same time, then just hit me with the email at the Parham team at Highlands Mortgage. It'll go to my two partners and myself, and we'll get right back with you.
Absolutely. Yeah, we are a 24/7 team, so reach out anytime.
Yeah, and we also have Graham's information on our website. When you log into RealWealth and you go to the resources page under lenders, you'll see Graham there, and there's all his information. And I believe we also have, we do have the investor loan guidebook on their link as well, so you can access that and contact him there. But yeah, let's go over some questions. So if you are still on the call here and you have some questions, feel free to type them in the box, or if you maybe jump in the call late, you can definitely, I mentioned you can type in a question on the box there, and we'll go through some questions here. So let's go through a couple here and you guys can answer them. So this is a question from Ridi. I think I'm pronouncing that correctly. They're asking, let's see here. What's your thoughts on paying points up front versus waiting and refinancing later? That's a big question we always get.
Well, if you were talking to another lender, I'd said pay your points. If you're talking to me, I'd said hold on to your points. Okay. If the seller's paying you 2 points, well, you have to leave. You don't want to leave it on the table. Okay. But if the seller's not paying those 2 points, you might want to consider taking the higher rate because it's only going to be there for 12 to 15 months. And then you're going to come back. We're going to refinance you. You're not going to charge any closing costs. Then you can pay points and buy it down even more. That's my recommendation.
Exactly, yeah, and I echo that completely. Inevitably, these mortgage rates are gonna come down in the next 2 to 3 years, and when they do, chances are you're gonna want to refi. Like Graham said, we'll waive our lender fees, so you're saving on closing costs there. So, and it comes back all to the break even that we touched on and a little bit earlier in the PowerPoint, and we'll do that math with you. One of those came out at 1.2, 1.5 years. So depending on, okay, I expect to maybe refi a year and a half or 2.5 years, that one could potentially come into play. You start making a little money back on it. So every property is different, day to day, hour to hour. It's even different as these rates move. But it all has to do with that break even, and then of course what you expect to do, especially regarding the refinance in the near future.
Yeah, and I'll add something real quickly on that. Some of the markets we're in, we offer new construction and high growth markets. Those are going to potentially appreciate at a faster pace than a home in Cleveland, Ohio, or Indianapolis, for example, right? I was on a call this morning talking about the same thing, and so yeah, and they're all great properties, but to refinance, you're going to have more equity potential in those higher growth markets, Florida, Texas, for example, the Carolinas. You're going to have more equity potential in those, so you will have the ability to pull out money. On the turnkey houses, it might take a little bit longer to do that. It might take 5 years to get equity or 6 years. So,
well, just to help share some of that with you from a personal aspect, I've been buying a lot down in Florida for the last 3 years. And all of a sudden, I put together a spreadsheet and put all my inventory on there, and I put the payments, the taxes, and everything else, and as well as the loan to values. I'm at 50% loan to value in Florida right now on all the properties that I own, and I only put 25 down. So if that helps you appreciate, yeah, it's fabulous. It really is.
Yeah. Thanks for sharing that. Okay, another question, the float down option. How does an investor know rates have gone down? Would you proactively reach out to them during closing period?
Yeah, I'll jump in there, Graham. Yeah, so once the program allows, once we're within 14 days, we'll start monitoring that and proactively checking that for our borrowers. At the same time, we have plenty of borrowers who are already taking advantage of it, kind of already in that reaching out on a daily basis, and that's totally okay. We'll continue to do the same from our end as well. So it's something we keep an eye on. We get updates every morning from our rate lock department. If we see that markets improved a little bit that morning, we're going through our whole pipeline and looking at any savings we could potentially help our borrowers with.
And let's be real about this. We're going to keep this rate lock float down program for a long time. Okay, is it good to take advantage of it? Sure. Once again, it's insurance. Are we expected those 1/4 point reduction within the next 6 months? Kind of hard to say. We haven't figured out where the feds are looking yet. Either way, it's a free program, and we are going to keep. If you were to say, hey, you got the float down next year, I would buy it all day long because it is going to come down.
Yeah, I'm glad you touched on that, Graham, because as we kind of alluded to earlier, we're probably expecting 2 more rate hikes before the year's over, so we're probably gonna maintain this mortgage rate level probably for the next foreseeable months. So while it might not be shining as bright as it can today, no doubt this thing is really going to be even more incredible come first quarter, fourth quarter of this year as well.
Perfect. Okay, John says, great presentation. Thanks, John. And he's asking, where are you guys physically located? What city?
Dallas, Texas. Well, it's actually McKinney or Allen, Texas. We're right about. It's one of the. We're in Dallas.
Yeah. Gotcha. And I think someone else alluded to this, but it's a good question. What states do you guys loan in?
28 different states. If you can think about every market that RealWealth's in, we're there. Okay.
Yeah. Gotcha. Perfect. Okay. Jason is asking, how should a partnership be structured to still be able to perform a 1031 exchange? That's probably a little bit more, a longer alluded question there, and you could probably have to talk to your accountant about that necessarily. But basically, what Graham was saying is, when you do an exchange, it's like for like, and it's the easiest thing to think about that, right? So that's what I've always keep in my head. So, but like Graham was saying, Graham, you said basically if someone had a single membership LLC, they can do a 1031 into their name or a single person's name. Is that what you were saying earlier?
Yeah, correct.
Yeah. So, but if you have like 4 people on an LLC and only, not all of them want to do an exchange, you're kind of probably in a tough. I don't think you can do that, because I had a situation recently when somebody questioned where family inherited a property or a bunch of land from their older family members that passed, and they were not even on the title, these new family members, and so they couldn't do a 1031, unfortunately, on that. So again, we have, if you go into the resources page, we have a 1031 accommodator or facilitator that you can talk to about that. She's great. She works in all 50 states, so you can definitely get in touch with her if you want. Let's see here. John is asking, would the HELOC from the primary residence be used as a down payment? The banks would loan the other 75% if the first 25% is from the HELOC. Does that make sense, that question?
Yes, that's correct.
Absolutely. Yeah, we have borrowers who do that all the time. In fact, I did that personally on my first property. Took out a HELOC, used that as part of the down payment, and then yeah, absolutely, the bank will lend on that other amount. So yeah, it's a great tool that we see our borrowers tap into all the time. There's a big thing with investment properties that we can't have gift funds used as the down payment. HELOC isn't considered gift, borrowed, that's equity in your home already. So absolutely, that works all day long.
Gotcha. Okay. Here's a great question from Aparna. They're asking, he or she's asking, is the closing cost deal, I'm assuming they're talking about the refinance program that you guys have, is available even if you sell the loan off, basically, I think is what they're asking.
So the one we closed today, or the one we
Correct.
closed?
Yeah, because you guys don't service the loans pretty much, right?
Well, no, we do. And that's an interesting thought, that back during COVID, we had no choice but to service 100% of ours, because all the aggregators, they left all the aggregators took their price up. We had the best price, so we sold directly to Fannie. Okay, we didn't sell the aggregators because their price was terrible. So I don't know if that's answering your question or what.
I'll jump in. Yeah, talking about the servicing. So to answer your question, you close the loan with us, we originate the loan, we'll still honor that, even if we don't end up servicing the loan. Caliber or Nation, whoever might end up servicing it, we are still going to waive our lender fee when you come back to us for that refi. Now, of course, keep in mind, we can't waive titles, closing costs, or things like that, but we can waive our lender fee, which is going to make up, probably close to 40–50% of your total closing costs, which will help save on that break even for the refinance.
Okay, yeah, that's what they're asking, I believe. So, okay, Brenda's asking, do you have blanket mortgage products, and how do they compare cost-wise to individual loans? I don't think you guys offer those, do you?
No, that's typically more of a commercial grade type of loan. And a lot of times they like to see, if you're doing multiple properties, they'd like to see them in a close knit area, like if it's all in the same neighborhood, but I'm not the expert in that. There are a couple lenders out there that do it, but once again, you're in the commercial grade category, which your rate's going to be higher.
Right. Gotcha. Okay. Let's see here. A couple more. We have time for a few more questions here. Let's see. How about, so here's a question, another HELOC question. Using the HELOC for the down payment basically becomes 100% financed property. Where are you finding properties that cash flow enough to cover 100% financed property? Does that make sense?
So it's spread out over 2 different properties.
I'm giving you 75% loan. That's what I'm doing. What you did is you went and got money, your own equity from your own house, which is your money, your equity, okay? Even though you took the balance up on that HELOC, all we do is count the payment on that HELOC. That's it.
Yeah, so
Right.
important, if you're the borrower analyzing, if you want to do that, very important to, I think, our borrower's question on this one, factor in. Of course, you need to factor in what that monthly HELOC obligation, what that payment's going to be back. You need to factor that in just, into your overall budget, just to make sure, pulling that 25 or 40K out of the HELOC for the next property, it's definitely something not to forget about. So that's a great point.
And if you do what Aristotle's talking about, going down to like Texas and Florida with the high appreciation states, 2 to 3 years from now, you can refinance and knock out that HELOC.
Right. Right. Yeah, we get a question about that all the time. People say, well, if I take a HELOC out and my payment is, is not going to cover the cash flow on my property, it is still a good deal. And I usually say, yes, it is actually, because you're taking money that you didn't have to take out of your bank account, your equity, right? It's basically tax-free money, and you're buying a cash flowing asset. So at some point, you will pay off your HELOC and you'll have that property. You own the new property basically with the capital that you use from the HELOC. And again, it did come out of your own pocket, just the equity out of your house. So I definitely think, like you said, Graham, earlier, use a HELOC. It's a great tool. It's a really great tool.
And typically the first 10 years of those HELOCs is an interest-only payment as well, which of course, if you're making that, you're not going to be paying off principal. But the point is that monthly payment could be very, very low, just to tap into that equity that you've got sitting there.
And it's tax deductible on the interest payments.
That's right. That's right. Yeah, good point. Okay, Prince is asking, do you guys help with HELOCs, or do they need to go somewhere else to get that?
They're going to have to go somewhere else. We have a HE loan, which I don't like, but I can direct you to somebody that can help you out, especially if you're trying to do it on your own property, your credit unions or local bank is probably your best bet on that. Sorry, I'm getting a call here. So yes, if you want to HELOC on your primary residence, they're still readily available. Credit unions always have the best terms from what I can see. HELOCs on an investment property, well, those are extremely challenging. I don't know where to direct you.
Okay. All right, one last question. Don's asking here, what's better, a 15-year or 30-year mortgage for investment properties? I know it's a subjective question, but.
Well, it's interesting. I had it locked in a 15-year and 3 years up until today. Guy wanted to pay 3 points to get that down in the sixes somewhere. Okay, tried to talk him out of it. Okay, and he says, I'm going to go buy 2 more properties down the between now and year end. Well, guess what happened? Remember that I was telling you about? I can do the 10 loans. If I can do 1 loan, I can do 10. Well, that goes away when you start putting the amortization on a 15-year term, because your rate or your payment's higher. Well, I got a good radius, but guess what? I can't qualify on that property over there. The other thing is Wall Street looks at these short-term products the same way they do the ARM products. They know they're going to have early payoffs, so they're just not juicing them like they used to. They're there. We have them. We'll offer them, but you'll have to pay for it.
Yeah, we're finding a lot of times you can get, at least lately, you can get better terms with that 30-year than you can the 15. And that used to not be the case, but for a couple of years now, we've seen that. We've been in kind of this inverted market. And what I always like to mention to my borrowers on the 30 with our Fannie Mae loans is there's not a prepayment penalty. We do ask that you make at least 6 months of payments, but you can make all the extra payments and turn that thing into a 15-year if you want to. There's nothing holding you back there.
If you want to email me, I have a Excel spreadsheet I can send you, and you can plug in whatever numbers you want. It'll show you when it'll pay off. So just let me know.
Awesome. Okay. Here's a non-finance question for you, Graham. Svetlana is asking, what's your exit strategy for your Florida homes that you have 50% equity? If you care to share that. I'm
a true buy and hold guy. I really am. I think I'm done selling. I took advantage of all my appreciations in all my markets. But right now I've got 10 that I'm being built right now in Florida coming off the ground. So that's my focus right now. And I hope between now and say a year from now, all of them will be done and all of them will be complete, and I'm keeping all of them because they're great.
Yeah. Well, if we don't see you in a couple of years, just because you're retiring to Hawaii and you're done.
Love it.
I appreciate it. Is that because I grew out a gray beard? Everybody's giving me a lot of trouble about this gray beard.
You're looking like Grizzly Adams. I have to say it a little bit.
Well, yeah, people say you're getting older. I said, so are you, whatever.
Yeah. Okay, perfect. Well, that's all the questions we have. If you go to the next slide, I think it's just the thanks for coming webinar. So I appreciate everyone coming on today and listening to this. You'll get everyone listening, you'll get a replay of this webinar probably within a day or two, and in your email, and you'll also find it on our website, hopefully. So again, Aaron and Graham, thanks for sharing all this great knowledge, and hopefully we'll be talking with you guys shortly again.
Thanks, Eric.
Thanks again.
Thanks, guys.